Have you ever wondered how some people turn a little into a lot, seemingly overnight? It may seem like magic, but it's not. It's the world of the stock market, a vibrant, bustling ecosystem where fortunes are made and dreams come true. Welcome to the first step of your journey towards wealth creation, where we demystify this fascinating world for you. Imagine the stock market as a bustling bazaar, full of opportunities. It's a place where companies from various sectors come to raise money, and in return, they offer a piece of their business, known as shares. When you invest in these shares, you essentially become a part owner of the company. But how do you choose which shares to invest in? How do you predict which company is going to be the next big thing? That's what we're here to find out. Whether you're a college student with a few spare rupees or someone just looking to secure your financial future, this guide is your first step towards wealth creation. Every investor, big or small, started from the basics. So, what exactly is a share, and how does the market work? A share, or stock, represents a unit of ownership in a company. When you buy a share, you're essentially buying a piece of that company. It's like having a slice of a large pizza. The bigger your slice, the more of the pizza you own. Now imagine a bustling marketplace. That's what the stock market is like, except instead of buying and selling fruits or vegetables, people are buying and selling shares. The price of these shares fluctuates based on supply and demand, just like in any market. If more people want a particular share, demand, its price goes up. If more people are selling that share, supply, its price goes down. A stock exchange is where all this buying and selling happens. In India, we have two major stock exchanges, the Bombay Stock Exchange and the National Stock Exchange. These platforms ensure that buying and selling of shares is smooth and transparent. Now, you might be wondering, why do companies issue shares in the first place? Well, companies need money to grow and expand their business. By issuing shares, they raise this money from the public, who in return become part owners of the company. The beauty of the stock market is that it allows us to participate in the financial growth of these companies. If the company does well, the value of your shares goes up and you make a profit. But remember, the opposite is also true. If the company doesn't do well, the value of your shares can go down, and you could incur a loss. That's why it's essential to understand the basics before you dive into the world of investing. It's not just about making quick money, it's about making informed decisions, understanding the risks, and staying committed for the long haul. Remember, every big investor was once a beginner. If you agree that everyone has to start somewhere, hit that like button. Now that we know the basics, it's time to build your financial empire brick by brick. Constructing a portfolio is an art and a science, and every successful investor has a well-thought-out portfolio. A portfolio, in simple terms, is a collection of investments. Think of it as a basket filled with various fruits, each representing a different kind of investment. Some fruits might be juicy stocks, others could be bonds, or perhaps a sprinkle of commodities or real estate. The trick is to balance the basket so it's not too heavy on one side. Choosing the right mix of investments is crucial. It's like picking a cricket team. You need a blend of batsmen, bowlers, and all-rounders to win the match. Similarly, a good portfolio has a mix of high-risk, high-return investments and low-risk, steady-income investments. This balance between risk and reward is what makes a portfolio robust. But there's another key element to constructing a portfolio: diversification. This is the idea that you should spread your investments across different sectors, industries, and even countries. Why, you ask? Well, if one investment goes down, others might go up, compensating for the loss. It's like having a safety net under your financial high wire. Diversification also helps you tap into various growth opportunities. For instance, if you invest only in the Indian market, you might miss out on the booming tech sector in the United States or the renewable energy wave in Europe. So, spreading your investments geographically can open up a world of opportunities. Remember, constructing a portfolio is not a one-time task. It's an ongoing process that requires regular review and rebalancing. As you grow and your financial goals evolve, your portfolio should reflect these changes. What's your dream investment? Comment below and let's discuss the best strategies. The numbers on the screen tell a story. Can you read it? Today we're going to talk about market analysis techniques. These are the tools you need to decode the market's narrative and make informed investment decisions. First up, we have fundamental analysis. This technique involves studying a company's financials, the industry it operates in, and the overall economic environment. It's like being a detective, looking for clues in balance sheets, income statements, and economic data to determine the intrinsic value of a share. If the market price is less than its intrinsic value, it might be a good buy. Next is technical analysis. This is for those who love patterns and trends. It involves studying price movements and volume data to predict future price trends. It's like weather forecasting, but for stocks. You use charts, trend lines, and indicators like moving averages to predict whether a stock's price will go up or down. Then there's sentiment analysis. This technique involves gauging market sentiment, or in other words, the mood of investors. It's like being a psychologist, but for the market. Social media trends, news articles, and investor forums can all provide insights into whether investors are feeling bullish or bearish. Finally, we have quantitative analysis. This involves using mathematical models to predict future price movements. It's like being a mathematician, but for the stock market. You use statistical techniques to analyze historical data and predict future trends. Remember, no single technique is the holy grail of investing. Each has its strengths and weaknesses, and successful investors often use a combination of these techniques to guide their decisions. It's also important to continually learn and adapt because the market is always changing, and what worked yesterday might not work today. In a nutshell, market analysis is about understanding the story behind the numbers. It's about making sense of the market's ebbs and flows, its triumphs and failures. So keep learning, keep analyzing, and you'll soon be reading the market like a book. Subscribe for more insights and become a market whiz. In the world of investing, risk is the name of the game. But let's not let that scare us. Instead, we turn the tables by understanding and managing these risks effectively. You see, every investment comes with its own set of risks. Market volatility, inflation, and even the potential for loss. It's just like sailing a ship in the open sea where storms are inevitable. So how do we navigate these storms? The answer is threefold: diversification, due diligence, and discipline. Diversification is like not putting all your eggs in one basket. You spread your investments across various assets to balance the risk. Due diligence means doing your homework before investing, understand the business, its prospects, and the market conditions. And finally, discipline. Stick to your investment strategy. Don't let emotions drive your decisions. Risk is inevitable, but it can be managed. Share this video with friends who need to hear this. Ready for the big reveal? Let's dive into some advanced strategies. You've built your foundation, crafted your portfolio, and learned the art of market analysis. Now it's time to take it up a notch. Advanced investment strategies are like secret weapons, unlocking potential for greater returns. First, there's the dollar cost averaging strategy. It's all about investing a fixed amount regularly, regardless of the share price. Over time, this can reduce the impact of volatility on your overall purchase. Next, we have short selling. This is for the brave hearts betting against the market, hoping that a stock's price will decline. It's risky, but the rewards can be substantial. Then there's margin trading, where you borrow to invest. It's like putting your returns on steroids, but remember, it's not for everyone. Lastly, diversification. Spreading your investments across different asset classes can help balance risk and reward. This is where the magic happens, folks. We've covered a lot today, from understanding the basics to exploring advanced strategies. We started with the fundamentals, defining what a share is and how the market operates. We then moved on to constructing your financial empire, your portfolio. We looked at market analysis techniques, taking you behind the numbers to understand the story they tell. We talked about risk, a constant in the investment world, and how to protect your hard-earned money. And finally, we delved into advanced strategies that can catapult you from zero to wealth. It's a lot to take in, but remember, every step you take is a step closer to financial independence. Keep exploring, keep learning, and most importantly, don't be afraid to ask questions. The world of investing is vast and exciting, and you're just getting started. Check out our other resources linked below, and remember, your path to wealth starts with a single step. Until next time, keep saving and keep learning.